Good morning and welcome to 5 Before the Bell, TheStreet.com's daily market preview. And it has to be said, European market update right here from the heart of the financial district in central London. I'm Martin Baccardax. I am the London Bureau Chief here at TheStreet.com, and I'm going to take you through those 5 things you need to know before the bell. There's a lot more than 5 today, as it typically is, but we've narrowed it down to the most important bits because it's going to be a fascinating session. Let's start with European stocks right now because we're looking at green across the board and a very bullish session for regional equities. It started in Asia, and of course it extended the rally that we saw last night on Wall Street, which took the Dow to another record close. What we're seeing here in Europe, though, is a nice broad-based set of gains. Switzerland is closed for a national holiday, but we are seeing significant portions of green across the board. We had stronger than expected earnings from a lot of blue chips. Infineon was one, BP was another, Rolls-Royce Holdings was another. So the underlying corporate perspective is very strong. The European economy is also running on all cylinders. In fact, the annual growth rate, as reported today by Eurostat, which is the official statistics agency, showed the fastest annual pace in 6 years. Now, the quarterly number was bang in line with expectations at about 0.6%, but the 2.1% annualized growth rate is, again, the fastest we've seen since 2011. We've been seeing the numbers come up inside readings of manufacturing and service sector activity, so it's nice to have it confirmed at the GDP level as well. The euro's been surging too. That's actually capped some of the gains that we've seen for European equities because it's trading at a 2.5-year high against the US dollar. The greenback, of course, is slumping, and we'll talk about the reasons why in a couple of minutes. But very healthy gains, and once again, it seems to me that European stocks are dictating the pace of activity on Wall Street because as we've gained, Wall Street futures have gained as well, and right now we're looking at triple-digit advance for the Dow based on U.S. equity futures prices. Now, let's move along to one of the big movers of the day. That's BP, the oil major, beating Q2 profit estimates today. Underlying replacement cost profits, say that twice very, very fast indeed, was much stronger than anticipated, $684 million US dollars against a company provided consensus of about $500 million. Now, production was very strong as well, and ultimately cash flow is looking very, very good indeed. The shares, in fact, were up about 3.2% at one stage to a one-month high. They haven't done a whole lot, it has to be said, this year, and they're still in negative territory, but it's been a nice little comeback over the past few months as a result of rising oil prices. However, what BP is saying about oil prices going into 2018 and where its debt levels sit at the moment do raise some questions for this stock. Debt, as it sits on the company's balance sheet at the moment, is at a record high of just under $40 billion US dollars. They've had to lever up as a result of payments that they've had to make linking to the Gulf of Mexico disaster in 2010. You'll remember, of course, the explosion on the Deepwater Horizon platform killed 11 people and resulted in the biggest oil spill in U.S. history around the Gulf region that is still being cleaned up. It's going to cost BP $62 million in pre-tax, $62 billion pre-tax dollars, ultimately to pay fines and penalties at the federal, state, and of course the civil level. Now, this year they're going to pay about $5.5 billion US dollars as a result of all of those agreements. They paid most of it in the first half of the year. Asset sales and cash flow, the company says, are going to cover payments for the second half of this year, and they are going to dwindle down to $2 billion in 2018 and $1 billion in 2019. And of course, then they'll be clear of all of the penalties. However, they're talking about an oil price that's in the range of about $45 to $55 in 2018. That seems to be relatively optimistic given the gearing level and given the leverage that we're seeing inside of BP at the moment, which is significantly higher than its chief rival, Shell. So, if we are looking at oil prices which are going through cataclysmic changes at the moment as a result of the way that cars are being sold, the way that cars are being bought, the way that governments are preventing the sale of diesel and petrol engines going forward, the way that shale oil production has accelerated to such a degree, and the way that OPEC doesn't seem to be able to maintain any discipline on its production cuts, a $55 a barrel mark for crude next year might prove to be very optimistic indeed. If it is, that is going to implicate cash flow for BP because its production isn't rising as fast as the oil prices would suggest. And as a result, that could pressure the balance sheet. But as BP rightly says, their borrowing costs are very low right now, and it is attempting to transition into other areas of production outside of traditional crude, and that may indeed give investors some comfort. At the moment, investors do like the stock, and it is trading very, very well indeed. But again, when you're looking at oil majors, the near term isn't nearly as important as the short term in the 2 to 3 years ahead. And then ultimately in the long term, we really don't know what is going to happen to global crude prices. So these stocks do remain very, very volatile indeed. Now, the US dollar has been volatile, but only really down in one direction. It's in the throes of the biggest losing streak in 6 years on a dollar index basis. That measures the greenback against a basket of 6 global currencies. It's clawing its way back into positive territory this morning, but it has fallen significantly over the past week and month, really as a result of the ongoing turmoil in the White House. Now, that didn't change at all yesterday with the firing of Anthony Scaramucci, who was the communications director for President Donald Trump for a grand total of 10 days. He was said to be let go on the advice of the new chief of staff in the White House, former Marine Corps General John Kelly. Now, he is in place to steady the ship and do little else. He is someone who is going to impose discipline on a fractured administration, at least according to the political pundits, and according to the chief spokesperson for the president's administration, Mr. Kelly, General Kelly, I think we should probably refer to him as, he's going to be the buck stops man. Everybody is going to report into him, and he is going to report into the president. This will, again, put some well-needed discipline on the administration as it continues to flounder, and this is the reason that we're seeing the dollar fall so significantly. But, I mean, when you look at the litany of challenges that faces this White House at the present time, already only into the 5th or 6th month of the administration, it's Herculean at best. We're looking at healthcare, tax reform, and stimulus plans that still need to be put through a recalcitrant Congress. We are looking at a budget battle at the moment, which is going to be linked to tax reform. We are looking at a debt ceiling debate, which is going to loom into the fall. And of course, Republican lawmakers are going to have to argue why the debt ceiling should be extended when they spent the last 7 to 8 years arguing that it shouldn't be. That's going to make for some interesting political theater indeed. And then we have to remember, of course, the geopolitical tensions that are rising, not only in the Asia region, but also even more closely to home, and those, of course, in and around the Gulf region. Now, furthermore, the president's trade ambitions are being tested at the moment because of the geopolitical tensions that we've mentioned in Asia and elsewhere. And of course, it has to be said, the tensions that are rising between the United Kingdom and the European Union as a result of Brexit, and what that will mean ultimately for a trade deal with the United States. All of this menu would be a challenge for the most disciplined of administrations and the most experienced of presidents. At the moment, though, we're looking at a political newcomer, and this is someone who has championed his lack of political experience as the reason why he should have been elected, because he was going to change things without having been encumbered by Washington bureaucracy. That hasn't proven to be the case just now. This is a new administration, it's a struggling administration, and it has a menu of challenges that are large and growing. So ultimately, you can understand why the dollar is pinned to 13-month lows, and very few people are assuming it's going to rise anytime soon. Now, Apple shares are on the radar today. They're going to give us third quarter earnings, their fiscal third quarter earnings after the closing bell today. Analysts are looking for revenues of about $45 billion in the 3 months ending in June. That would be up 6% from the same period last year. And they're looking for earnings per share on a GAAP basis of about $1.57. That would be up 11% from the same period last year. I really don't think, though, that the Q3 numbers are what investors are going to be looking for. We understand that the third quarter, in Apple's perspective, is usually one of the slower with respect to iPhone sales, and iPhone sales comprise about 50% of the company's revenues. What is going to be important is what the company says about its fourth quarter revenues, and that is the quarter that ends in the month of September, because September is traditionally the month that the new iPhones are launched. And of course we know, or at least we are anticipating, that the iPhone anniversary edition, the iPhone 8 or the iPhone X or whatever you like to call it, is likely to come in that month. However, here's the key. Analysts are looking for a Q4 revenue projection of about $49.2 billion US dollars. If it falls short of that, that could be a tacit admission from Apple that production delays, which have been part of the Apple rumor mill for many, many months now, are true, and that the iPhone could be delayed into the first quarter of the company's fiscal 2018 year. That would be troubling indeed, because firstly, it would be the first iPhone delay in the company's history. And secondly, as analysts have noted, it wouldn't indicate incremental gains for shareholders, but merely a redistribution of revenue over 2 different earnings periods. And that could raise questions about the value proposition in a stock that is relatively expensive right now, as it trades at around $150 a share. Now, we're going to look for iPhone sales around the 25.5 billion US dollar mark for this current quarter, for the quarter ending in June, and that would probably mean about 55 million units that were shipped. I'm going to be focused not only on the Q4 projections, but also the average selling price, which analysts expect to rise by about $26 to 621 US dollars. Lots to pick through in these numbers. TheStreet.com will have, as ever, a live earnings blog just before the earnings come, and then right through to the end, taking you through it line by line, so do definitely check it out. Now, as I say, Wall Street called higher, triple-digit gains anticipated for the Dow. 104 points to the good is what futures are pointing to right now, and that, of course, is after last night's record close. We're looking at the S&P 500 adding about 0.2% and a little bit stronger gains for the NASDAQ, owing to the fact, I would imagine, that Apple shares are called a little bit higher today. Now, lots to watch for in terms of earnings. Sprint is going to give us their quarterly earnings numbers in a few minutes' time. Check out TheStreet.com for the headlines there, but analysts are looking for about a penny lost per share and revenues of about 8.2 billion. Subscriber numbers, as always, are going to be key for the wireless carrier. Pfizer are also going to give us second quarter earnings figures. Analysts looking for 65 cents a share on revenues of about 13.1 billion. The pipeline is always key, and ultimately what the company has to say about dividends and share buybacks, because this has been a very lucrative stock to hold from an investor perspective, even though its capital gain has only been about 2% year to date. One of the most interesting stories today, though, is going to be Snap. We talked a lot about it yesterday, so I didn't want to break it down today, but nonetheless, the S&P 500 is going to eject Snap shares from the indice, and in fact, all of the S&P indices are going to reject not only Snap, but all shares that have dual class structures. Those are the ones that don't give voting rights to investors and keep them entirely enclosed within management or ultimate high-end ownership. This is a blow to Snap, of course, because the FTSE Russell has also kicked it out of its benchmarks because of this structure, and investors are raising all sorts of questions about the probity of these dual-class structures. It has to be said, though, even as they bought into the IPO, which raised $3.4 billion back in March. So I'll be interested to see what Snap shares do at the open. If you'll bear with me, I can tell you where they are trading pre-market, because this is going to be certainly a headline story given all of the exposure that the stock has had around the IPO. It's called about 0.5% higher, it has to be said, at the moment, and the shares that original investors were given during the IPO period have expired in terms of the lockup phase, and they are, of course, free to trade now right through to the end of the month. So the shares are going to be volatile over the next 2 to 3 weeks, but we aren't going to see them in the S&P 500 because that ruling is effective as of today. Well, that's it for me as of today here in central London, and that was 5 Before the Bell. Thanks very much for watching. I'm Martin Baccardax of TheStreet.com. We'll see you tomorrow.